In this video, we're going to talk about Roth conversion mistakes. Roth conversions can be a great strategy to help you reduce your taxes, to help you keep more of your retirement savings, to help you have more income coming in to be able to spend in your retirement. However, there are 5 common mistakes that can be made, and when made, could actually cost you more in taxes, could create tax penalties, could cost you more in Medicare premiums, and give you less to spend in your retirement. So we're going to cover those 5 mistakes so that way you're not making them in your retirement. Hey, for those of you that are new to the channel, my name's Scott Sierens. I run a retirement planning and investment management firm where our mission is to help good people make great financial decisions to be able to maximize their retirement story. So today we're talking about Roth conversions. A Roth conversion, let's just talk high level really quickly. If you're here, you probably already know what it is, but a Roth conversion is when you take your IRA money and convert or shift it over to a Roth IRA. When you do so, you have to pay tax today at today's rate. So you're going to go from IRA to Roth IRA. In the Roth IRA, since you've already paid the tax, whatever you've put in is tax-free, and any of the growth in the Roth IRA is tax-free as well. So as you can see, this can become a very powerful tool for some future tax-free income. However, when doing these Roth conversions, and always speak with a financial professional, speak with a tax preparer before going to do a Roth conversion. And it's because of these mistakes that I'm going to talk about today. So let's just dive right in. What are some of the common mistakes? Well, mistake number 1 is converting all of your IRA in 1 year, or converting too much of your IRA in 1 year over to a Roth. How is this a mistake, or why does this become a potential mistake? Well, if you think about it, as I had mentioned, when you do a Roth conversion, when you go out of your IRA to the Roth, you have to pay tax today. So that Roth conversion amount is taxable income. The more income that you have coming in, the higher that you go in the different tax brackets. So if you were to take and do a very large Roth conversion, or all of your IRA in a Roth conversion in 1 year, you might now put yourself into tax brackets that you might not otherwise see throughout your lifetime. And so if you're doing that, you're putting some of that money into tax brackets that you never see in your lifetime. Well, now you're actually paying too much in taxes on that money. You know what? I've created a great hypothetical scenario here just to be able to show you what I mean by this. So let's just take a look here. We've got Steve and Sue sample. I've used this sample before in other videos that I've shown. And just high level for Steve and Sue here, they've got $1.5 million in tax deferred money. IRAs, 401ks, 403bs, 457s, all of that's tax deferred. Roth conversion is going from the IRA to the Roth IRA. You could go from sometimes you can go from your 401k to your Roth 401k. All of that is converting money to a Roth. When you do so, adds into that taxable income. What becomes really important here is not only understanding how much they have in tax deferred assets, but also what does their future taxable income look like? When will Steve and Sue retire? How much will they have coming in Social Security? When do they plan to take their Social Security? What do they have for employment income now, Social Security income now? What are they saving towards what types of accounts? So we can put all of that together, and what it's going to give us is a tax projection. For a Roth conversion, so super important, is that you're doing a tax projection. Not only what does this year of taxable income look like for you, but what do future years of taxable income look like for you? And as you can see for Steve and Sue sample here, that's the shaded blue area. And so they're going to have some ups and downs of taxable income depending on when they retire, when they start taking Social Security. Oh, and then by the way, as we always remember, with IRAs, 401ks, 403bs, 457s, tax-deferred accounts, you have to take those required minimum distributions starting at either age 73 or 75, and who knows, they might change the ages again in the future. And so you can see in this scenario here for Steve and Sue, their taxable income will be higher in the future than where it's at today. Now, if we take a look, at the different horizontal lines there, we've got the bottom line, the 10% bracket, the green line, the 12% bracket, which becomes 15% when the tax laws expire, the yellow line, the 22% bracket, the dark yellow, kind of more of an orangish line, the 24% bracket, and then not even on here is the 32% bracket, the 35% bracket. Now, if we go, and when you do a Roth conversion, it should be very strategic. And so that's why I find, and it's mistake number one, people are doing too much, or they're trying to do it all at once versus being strategic about it. So if we go here and we say, hey, what if Steve and Sue were to fill up the 22% bracket with Roth conversions, but not go over that? As you can see here on the right-hand side, proposed strategy, $373,000 more in ending assets. I would say that's a great thing. Lowering their taxes, it's creating more wealth for them, more assets overall. But let's say Steve and Sue said, hey, we're going to try to do a ton of this, all in 1 or 2 years. We're going to go up to the 35% bracket. Well, again, they were never going to see the 35% bracket throughout their projected taxable income. And as you can see here, it's actually going to result in less assets for them over time. Reason being is because now they've converted so much up front, they're paying 30%, over 30% in taxes on some of those dollars that they probably would have never paid 30% on those dollars in their future. So mistake number one is converting too much or all of your assets in 1 year. Now, there might be special circumstances where that does make sense, but that's where tax planning and having a tax projection come into play. The second mistake when it comes to Roth conversions is converting to Roth when your tax rates will go down in the future. Let's think again, why do we do a Roth conversion? Well, when we do the conversion to get the money into that tax-free bucket, we pay tax in the year that you do the conversion. So if your tax rates are going to be lower in the future than where they're at today, it doesn't make a whole lot of sense to convert the money from the IRA to the Roth IRA today. You're going to be overpaying in taxes. So that comes back to doing a tax plan and a tax projection to know if your taxable income and your tax rates will be higher in the future or if they'll be lower in the future. Mistake number 3 is converting past Medicare IRMAA thresholds. You see, when doing that Roth conversion, again, and I'm just continuing to reiterate this, it adds into your taxable income. Well, if you're not paying attention and your Roth conversion could potentially take you over a Medicare IRMAA threshold. What does that mean? Well, that means then in 2 years from when you did that Roth conversion, your Medicare premiums could go up. They could go up by hundreds of dollars. They could go up by thousands of dollars, depending which Medicare threshold you go over. So sometimes you want to convert to the top of a tax bracket. Sometimes, for those of you that are age 65 plus and on Medicare, you just may want to convert up to a Medicare premium threshold. Again, let me just give you a quick example of what I mean here. Back to Steve and Sue's sample. Now, instead of having the tax brackets in their projections here, we're looking at the Medicare IRMAA brackets, Medicare premium tax brackets. This is when, if you surpass one of these brackets, your Medicare premiums, base premiums, are going to go up. It's like a surcharge on your Medicare. And so you can see that Steve and Sue's sample here pretty much wouldn't have any sort of surcharge until that dive in the lines on the right-hand side. Why is there a dive in the lines? That's us simulating what if one person were to pass away. That's what's creating that. So maybe if one of them passed away, the remaining spouse would see a couple Medicare premium adjustments. So for them, then maybe right now it makes sense to go up to where the Medicare premium adjustment would take place, but not go over it. But a common mistake when people are converting to a Roth IRA is they're just going about it and they're like, oh, I'm going to go up to the top of the 22% bracket or the top of the 24% bracket. And then 2 years later, they find that their Medicare premiums go up by hundreds of thousands of dollars. So avoid the mistake. Make sure you're not only looking at tax brackets, you're also looking at what's going to happen to your Medicare premiums. Mistake number 4 is the tax mistake. And actually, this one has multiple parts to it. There are multiple tax mistakes that could potentially be made. So when doing a Roth conversion, reiterating, you got to pay the tax when you do the Roth conversion. Well, that's the big mistake some people can make, is they forget to pay the tax, or they don't pay the tax. And so then guess what? In April, they have a big tax surprise. So one, make sure you understand the tax that you're going to owe. Now, this brings up another mistake under the tax mistakes, is when are you paying that tax? If you don't have any other income going on throughout the year, maybe you've kind of structured yourself to be able to do the Roth conversion, well, you need to then be making quarterly payments. I find sometimes people won't make any payments at all, then they'll make the payment at the end of the year, and they have not been withholding anything. Nothing's been going to the IRS throughout the year. Well, the IRS doesn't like that so much, and guess what? You'll actually have a penalty. Even if you've paid in enough, you could still have a penalty for not paying in quarterly throughout the year. The Roth conversion, they're going to look at that you took that money throughout the year, not just in one specific quarter. So not making quarterly payments or understanding when you need to make payments can be a tax mistake as well. And then the last tax mistake, which could and could not be a mistake, so just understand that up front, is withholding the tax from your IRA. The reason I say could or could not be a mistake is there are plenty of people that need to. The only money that they have to be able to pay the tax on their Roth conversion is by withholding it from the IRA. But you might read somewhere that this is a big mistake because then not all of the money is getting converted over to the Roth. Well, here's the thing. If you do have outside money, brokerage account money, savings account money to pay the tax, you'd want to use that money. Why? Because if you're converting $100,000, let's just say you have a 20% tax rate, you're converting $100,000. Well, that's $100,000 going to cost you $20,000 in tax. If you convert $100,000 and pay the tax from somewhere else, well, you now get $100,000 going into your Roth IRA, working tax-free for you. Let's say you don't have the money to pay the tax from somewhere else, so you have to withhold it from the conversion. That means $80,000 goes into the Roth, $20,000 goes to the IRS. You're only getting $80,000 into the Roth versus the full 100. Is it the end of the day? Nope. You're still doing a strategy that is helping your overall scenario, but if you do have outside money to be able to pay the tax bill, you'd want to use that first. Hey, if you're enjoying this video so far, and I'm guessing if you're watching it, you've got probably retirement savings in IRAs, 401ks, 403bs, and you're looking for additional ways to save tax dollars on those retirement savings, check out our free guide to unlocking hidden tax savings opportunities. You can get it at lifemoneyshow.com/taxes. All right. Let's talk about the fifth mistake that people could make when doing Roth conversions, and that's doing it too early in the year. A lot of times when we're working with clients and we're doing Roth conversions, we're waiting till October and November to do the Roth conversions. Why is that? Well, because it's all based on taxable income. If you do it too early in the year and then you have more taxable income come in than you thought you would have had come in, well, now it might be throwing you up into tax brackets that you might not have been in. So we always like to wait till the end of the year so you have a really good grasp on how much taxable income that you'll have coming in. And then that way you're hitting and you're strategizing up to those tax brackets or up to the Medicare brackets and not going over. Again, do it at the beginning of the year. It's possible you can do it, but you better have a really good grasp on how much income you're going to have coming in that year with no surprise income coming in either. So I hope you found this valuable and beneficial. Again, 5 big mistakes when it comes to Roth conversions that can, as you can see, maybe cost you too much in taxes, could cost you too much in Medicare premiums, if you're paying too much in taxes, it gives you less money to spend. It could be causing penalties if you're not paying the taxes on time. This is why for all of our clients, we meet in October to do year-end tax planning strategies to go through these to help avoid these mistakes and properly help them convert IRA dollars to Roth IRA dollars. Again, working with us, working with their tax preparer to get all of that done. But if you're doing it on your own, hopefully this will help you avoid some big mistakes. If you've enjoyed the video, subscribe to our YouTube channel. That way you get notified. We're coming out with new videos each and every week to help you maximize your retirement story. Thanks. Have a great day.